We want to take a look back at 2012 and then try and look forward to 2013. On the currency front, let's begin there. Your expectations at the beginning of the year versus the outcome, any big difference?
Sorry, I didn't hear that. Your volume is very low.
Okay, let's try again. I was asking you to review for me whether the outcome of the foreign currency market trading patterns that we saw in 2012 was the same as you expected at the beginning of the year.
Well, I think in terms of the currency market, I believe there's been appreciation of about 3% this year on the Naira, and that has not happened in a while. For you to have a year where the Naira closes the year above where it started. So I think that's a big positive. And it must have influenced the foreign flows of capital into the treasury and bond markets.
Yeah,
that was probably not expected at the beginning of the year, no.
Absolutely, that's what I wanted to get a sense from you. So when you look now at some of the reason behind the the currency appreciation that we saw in 2012, do you expect those to be still around in 2013, particularly inflows into the Nigerian bond as well as the equity market?
Well, I think in terms of one thing is obviously the oil price. As long as the oil price remains at this level, the foreign reserves should keep growing, and that should give some confidence to foreign investors about the ability of the central bank to maintain currency stability. But the easy money has probably been made in terms of having those very high interest rates that were approaching 20%, all-inclusive rates. Those have dropped substantially. So some of those capital flows might slow down, and that will have an impact on the currency, a negative impact.
Okay, so when you look out into 2013, what's your expectation then for the currency?
Well, not much change. The central bank has a tight 3% range. They expect the currency to stay within, and there's no reason to think of right now why it should move outside that range. If oil prices fall substantially, maybe below the $90 a barrel mark, then things could look a bit different.
Okay, so let's talk about the bond market now. That was one, of course, the star attractions. We did see inflows coming out in the Nigerian market. We know that investors globally have been chasing yield. For you, when you look at 2013, is that likely to continue?
Sorry, I didn't get that. The volume is really low.
Okay, so I was asking if your expectations for 2013 for the bond market, particularly given the fact that we did see foreign inflows into the Nigerian bond market this year.
Yes, in terms of next year for the bond market, right now the market is at, the prices are at multi-year highs and the yields are at multi-year lows. So it's hard to see this kind of performance next year. Having said that, if the currency outlook remains where it is, stable, there will be some foreign flows coming in, but probably not in the magnitude of this year, or not the kind of a big spike we saw this year.
What about the interest rates themselves and the yields on those bond markets?
Well, the yield one is a bit interesting because right now we're seeing yields under 12%. When you bear in mind that the MPR rate is 12% set by the central bank, I'm not sure when last you had long-term bond market yields below MPR. So clearly something has to move. Either MPR starts to trend downwards, or there's a bit of a mismatch, particularly when you bear in mind that inflation is around 11.7. So the positive yield on this bond has almost evaporated, at least inflation adjusted. We're almost back to 2010 where you had negative real interest rates. And we know what happened after that. Prices had to go back down and yields up. So it's hard to see a sustained downward trend in interest rates, maybe a few basis points from here. But if you start having that huge negative interest rate gap that we've had in the past, then there could be some downward price adjustments in the market.